Good morning, happy Friday. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Another day, another tariff rollback. Donald Trump pauses levies on Canadian and Mexican goods that comply with the USMCA trade deal. Asian stocks slide on the uncertainty. We preview today's US jobs data. Bitcoin falls after a Trump executive order for a crypto reserve disappoints investors. The White House crypto czar saying taxpayer money will not be used to buy digital assets. Plus, Bloomberg learns the US wants to link a minerals deal with a quick ceasefire between Kyiv and Moscow. Ukraine's president says he will speak with US officials in Saudi Arabia next week. So yes, the tariff whipsaws, the tariff U-turns. What does President Trump want ultimately with these tariffs? That remains a key question, it seems, for investors and, of course, businesses as well. European futures pointing lower after ending the session flat yesterday, currently pointing lower by 0.9%, largely on that uncertainty. We build up to the jobs data. The US, after one of the surveys yesterday, suggested that there is significant cutting coming through, particularly when it comes to federal workers. We've seen that, but also tech and retail. FTSE 100 futures pointing lower by 0.4%. S&P futures stateside after falling more than 1% yesterday, currently pointing lower by 0.2%. The pressure has been on the tech trade of the US, and you saw that theme continuing with heavy losses yesterday. The semiconductor space, Mag 7 now in correction territory. The Nasdaq 100 closing in to correction territory. Today, though, futures pointing modestly higher on that tech-heavy index, up by 0.3%. Let's flip the board and look cross-asset. The bond sell-off that we've seen this week, getting something of a reprieve in the session today. The 10-year benchmark in the US currently yielding 4.24. Yields actually down close to 4 basis points. The euro strength continues, though. The single currency up 0.3% in the session today. We had the ECB cut as expected yesterday, but there is a big question mark around their April decision going forward. 108 on the single currency. Bitcoin taking a bit of a hit on that executive order and disappointment within the investment community in the crypto space. 88,000 down 2% so far in the session. Brent on the oil space currently up 0.1%. Let's cross over right now to Singapore. Avril Hong standing by for a check on the Asian markets, and it's a bit of a mixed picture, Avril.
It's a mixed picture, but you can clearly see how investors finding it difficult to position, businesses finding it difficult to do business amid this lack of long-term clarity on US trade policy. So that's really what's sapping risk appetite in most of the region, including on the Japanese Nikkei, that is the outlier, the underperformer, I should say, and the losses there being exacerbated by the yen strength. And we're seeing dollar yen below 148, and this is against the backdrop of the largest trade union or labor union in the country, I should say, calling for the biggest rate hikes or wage hikes, I should say, since 1993. Now, to your point about it being a mixed bag, it's really about the Hang Seng outperformance. Flip the board. Let's talk about what's driving this. It is, no surprises, led by tech. And if you're looking at the Hang Seng Tech, following the crash last Friday, it was a bit shaky at the start of the week as we waited out for NPC details. And then we got that focus on tech and consumption. Alibaba unveiling its AI model. And today it's headed for a third day of gains. And mind you, if you're looking at the start of the year, the biggest Chinese tech names, the biggest 7 of them, they've added about $440 billion in market cap as the Mag 7s sink. And these gains you're seeing in the Hang Seng Tech for the week, a bit tepid now, comes in spite of trade data that shows you exports that, just rising less than expected in China, and really not a good sign amid the external environment. Tom.
Yeah, the 7 titans and the outperformance of Chinese tech versus their US counterparts. We'll see if that theme continues. Avril Hong with a check, of course, on the Asian markets this Friday, joining us out of Singapore. Thank you, Avril. Now, to the tariff question and the details around what is transpiring. President Trump now pausing tariffs on Mexican and Canadian goods covered by the North American Trade Agreement, the USMCA. That includes items such as autos and certain fertilizers. The duties are now delayed until April the 2nd. That's also when Trump is expected to unveil plans for global reciprocal duties.
Most of the tariffs go in April the 2nd. Right now we have some temporary ones and small ones on relatively small, although it's a lot of money, having to do with Mexico and Canada. But the predominant tariffs will go, they'll be reciprocal in nature.
OK, well, for more, let's bring in Bloomberg's East Asia government editor, John Herskovits. John, does this Trump administration know what it's actually doing with tariffs? And to what extent, what details, what items from Canada, from Mexico, fall under this temporary reprieve?
Yeah, it's difficult to say. We've seen the whiplash going on with the tariffs on, tariffs off. The market's up, market's down. We had some rallies in the peso and Canada's currency today. Under Bloomberg data, it's about, when it comes to Mexico, which is heavy in agriculture, about 49% of its items would be exempt under USMCA, under the trade agreement between the three, and about 41% are in a gray area. A U.S. official said that with Canada, it's maybe about 60%, and the key issues for Canada specifically are, and also for Mexico, are auto parts, because the automobile industry between the three countries are so intermeshed. And with Canada, you have the fertilizers. Potash is one of the items that's part of this. So, it's difficult to say exactly like some of these smaller items where they may fit in, but these are some of the bigger items that are under the trade agreement between the three countries, which would be able to dodge the tariffs that were set to be imposed earlier this week.
Yeah, and look, as you've broken down for us in such an excellent manner, this is complicated, isn't it? And it just makes the question of how you plan on investments, if you are a company, that much more challenging. What happens next then, John?
We're waiting for the April 2nd, the imposition of the reciprocal tariffs, and also what will happen with Canada and Mexico. So you'll have various industry sectors who are lobbying the White House now. Yesterday, on Wednesday, India's foreign minister said that the trade minister from his country was in Washington for talks. You're seeing a lot of these bilateral talks going on where countries have dispatched their trade minister to the U.S. trying to get more favorable terms for their goods, leading up to the April 2nd reciprocal tariffs. What exactly is going to come up, we don't know, but it's causing a lot of anxiety in governments, in trading houses, in industry groups. And we just have to wait and see until next month when April 2nd rolls around.
OK, yeah, let's see if we get more clarity or more confusion come April the 2nd. John Herskovits with a great breakdown of what has transpired just in the last 12 hours or so on the tariff story that continues to, of course, keep us on tenterhooks with the details there. Let's get the market reaction then to this confusion, to this anxiety that John was talking about. Federal Reserve Governor Chris Waller has repeated his assessment, meanwhile, that the impact on prices from those tariffs is likely not going to be significant. So on that level, aligning at least with the Trump administration's own assessments. Meanwhile, the US Treasury Secretary Scott Bessent defended President Trump's trade policies.
People say, oh, tariffs are a regressive tax. Well, are they a regressive tax if you then use the income from tariffs to no tax on tips, no tax on Social Security, no tax on overtime, making auto loans tax deductible? Those four policies, which President Trump put forward during the campaign, all accrue to the bottom 50% of wage earners and working Americans.
OK, for more, let's bring in Bloomberg's Valerie Teitel. Val, the market reaction then, just to the latest tariff news. Do they know even where to look at this point?
Tom, the market has been all over the place this week, to say the least. Now, the most important thing from the price action yesterday is the recent delay in these tariffs to April 2nd did not a lot to lift equity market sentiment. We closed near the lows in the S&P 500, and on the week, S&P futures down 3.5%. It's gone from a tariff delay being a good thing, from a tariff delay being a bad thing now. It just prolongs the uncertainty for more weeks to come. We're seeing equities to the downside downside. It's also hurting the tech stocks, those high beta stocks as well. We've seen the NASDAQ slide near 10% from its highs only 2 weeks ago. If we look at the Magnificent Seven, Tom, this chart really caught my eye this morning. The Mag 7 is now trading below its 200-day moving average for the first time in 2 years. The equity momentum is to the downside. The one thing that could shift this is perhaps a good payroll print today. We have that NFP dropping at 1:30 UK time. Consensus is for 150K print. The unemployment rate to stay steady at 4%. But there has been a lot of attention lately on the jobless claims from federal workers. So the skepticism here is that when will we see these public job losses lead into the private sector? Some are calling that not to hit until the second quarter, maybe in the March print, not this month's print. But the risk is that we get a weak print and this equity move to the downside extends into the weekend.
Okay, Valerie Teitel with a preview as well of the jobs data. Hourly earnings, I should say, average hourly earnings expected to dip month on month. So we'll watch that number as well within the mix. Val, thank you for the market breakdown and the preview of the jobs data. Let's get to the defence spend story then that continues to, of course, to evolve. Bloomberg understanding that European officials have been told that President Trump wants to link the proposed US-Ukraine minerals deal to demands for Kyiv to commit to a quick ceasefire with Russia. This comes as the US confirms that officials will meet with their Ukrainian counterparts in Saudi Arabia next week.
I think it'll be a good meeting. I really do believe that. Hopefully that'll be a good signal to the Russians because they have been proactive too in wanting to get something done here. And I think that's what the president, that's who he is. He's a peace through strength president. The best wars are the wars that never have to get fought. And so if we can solve this and not fight anymore and save lives, that's the aim of President Trump.
Okay, Steve Witkoff saying the Russians have been proactive on this as well. They have provided, of course, the Trump administration no details on what exactly Russia has been proactive on when it comes to these discussions. Meanwhile, EU leaders have met in Brussels to try to mobilise hundreds of billions in extra defence spending to counter the threat from Russia. Let's bring in Bloomberg's Oliver Crook, who is there. Ollie, there may be some movement then on the Ukraine minerals deal, it seems.
Yeah, because, Tom, there's a major difference today versus last week, right, which is that now basically the United States has paused its military aid to Ukraine, has paused most of its intelligence gathering, sharing with Ukraine. And so they're really pushing that contract forward towards Zelensky once more with those very sort of real differences in the sort of calculus. And that is something that obviously the president of Ukraine cannot ignore and is going to be forced increasingly to the table for, particularly in the fact that despite the fact that he was here in Brussels with EU leaders, there was nothing that sort of came in terms of more material support. There had been discussions about potentially another 20 billion euro package that sort of evaporated from the conclusions. And we got it very clearly from Mike Waltz speaking yesterday, saying that basically the move towards these negotiations and confidence building measures on the table, that would make the president take a hard look at removing the pause on weapons and intelligence sharing. That's directly linked basically to Ukraine's willingness to move quickly on these sort of the minerals deal with explicitly a path towards a ceasefire. Of course, the Ukrainians have been resistant to do this without the sort of guarantees of ceasefire, the guarantees of security guarantees provided by the United States. That being said, the U.S. for its part says that basically if you create economic vested interest by the U.S. in Ukraine, that sort of is a security guarantee. Of course, that ignores the fact that if, say, Russia were to reinvade Ukraine and take the territory, they could still honor the precious metals and then those sorts of contracts, which would really, if that's the only thing that it comes down to, wouldn't really be sufficient in giving the Ukrainians a kind of certainty and the kind of safety that they're anticipating. But of course, this is sort of the reality of basically turning the screws on the Ukrainians, pushing it forward. Zelensky, we understand, will meet with Mohammed bin Salman, the Crown Prince of Saudi Arabia, on Monday, and his team will hang back for a few days to discuss with the U.S. administration.
Ollie, meanwhile, in Brussels, you were at the event, of course, you were at the summit, you were following the discussions. The EU agreeing then to reform those fiscal rules to boost defence spending. Where are we in this process?
Yeah, so listen, let's look at what we actually got sort of materially. We mentioned that we expected potentially another 20 billion euros in terms of a defense package for Ukraine. That did not happen. There was a sort of there was a discussions about potentially putting forward one representative to help sort of negotiate on Europe's behalf. This is another thing that's been talked about for the last few years. That did not happen. What did happen was sort of moving forward on this idea of the fiscal rules. The EU says that this could unlock basically 650 billion euros over 4 years. We should say, though, that with these fiscal rules, a lot of these fiscal rules are also not necessarily followed by many European countries to begin with, right? They're often run afoul of them. And basically, just because you give the extra headroom to do more spending at the national level, basically allowing countries to acquire more debt, doesn't necessarily mean that they will do it, right? There's also other limits. There is, for example, the bond market. There's also fiscal strain within a nation. So that 650 billion euros is not necessarily, direct money. There's also this 150 billion euro loan that the EU has been talking about. They said that they're going to pick that up and examine it as a matter of great urgency. But again, in terms of the new money and the real sort of new money going towards defense, the main event this week was not out of the EU. It was out of Germany. It was out of Friedrich Merz. It was about that sort of basically trying to release the debt brake and get hundreds, if not close to €1 trillion worth of spending towards infrastructure and defense. And that is really going to be sort of setting the drumbeat for European defense. And of course, there is, of course, the question that they put out a statement with only 26 member states signing to it, Hungary being notably absent throughout this whole process in terms of endorsing Ukraine and military aid there.
Yeah, and Ollie, as you say, the small matter of the bond market that, of course, has asserted itself aggressively into this conversation this week. Oliver Crook in Brussels with the latest on how Europe is trying to build out its defence capabilities. Thank you, Ollie. At 7:30 a.m. UK time, we will stay with that topic because Ollie will be speaking exclusively with the European Commissioner for Defence and Space, Andreas Kubilius. So stay tuned for that crucial conversation. Really interesting insights to come from that interview, no doubt. 7:30 a.m. UK time. Coming up, Chinese Foreign Minister Wang Yi says Beijing will act as a force for stability as President Donald Trump's tariffs shake up the global economy. We are live in Beijing next. This is Bloomberg. Chinese Foreign Minister Wang Yi is presenting the country as a force for stability in a changing and turbulent world. It comes amid growing US-China tensions after President Trump doubled tariffs on Beijing to 20% this week. Wang Yi vowed to defend global fairness and world peace.
New China stands firm on the side of international justice and resolutely opposes power politics and hegemony. History should move forward, not backward. A big country should honor its international obligations and fulfill its due responsibilities. It should not put selfish interests before principles, still less wield its power to bully the weak.
OK, let's cross over to Bloomberg's chief North Asia correspondent, Stephen Engel, standing by for us in Beijing. Look, Steve, as you well know, Wang Yi is one of the most seasoned leaders in China, one of the most seasoned diplomats. What for you were the key takeaways from his speech?
Well, you know his character, Tom, when you were the Beijing correspondent. Wang Yi, among all the ministers of the major ministries here in China, is perhaps the most sharp-tongued, and he did not disappoint today. There was not a lot of new material to chew on, except the fact that this was in direct, the first time we've really heard from him since the Trump administration upped those tariffs in relation to what they perceive to be inaction on the fentanyl issue earlier this week to 20%, from 10%. So much of the press conference that lasted about an hour and a half, which I attended with Wang Yi, he took issue with the Trump administration. He referred to it as basically abiding by the law of the jungle. He mentioned that twice, and he also said China opposes double standards, trickery, and bullying. And on the fentanyl issue, he went off even more. He says China always resolutely battles against drug trafficking, one of the toughest against drug trafficking in the world. He slammed America's stance on this, blaming China as being two-faced, and says fentanyl in the U.S. is a problem that needs to be addressed by the U.S. itself. And he vowed to continue. Beijing will continue some countermeasures against tariffs if Trump administration levies further moves. They will continue to do those countermeasures against what he called arbitrary actions from the United States. It was a wide-ranging press conference that talked about Taiwan. Nothing new there. China, again, reaffirming their stance that Taiwan is an unalienable part of China and cannot be fractured from the motherland. He also talked about the Ukraine war. He said Beijing will continue to seek peace in Ukraine. But when asked by Bloomberg News whether in that process, if there is a peace process, whether the parties involved are the United States, Russia, Ukraine, and China, whether China would send peacekeeping troops to help keep the peace, he didn't touch that one at all. Not too surprising, though. Tom?
Okay, fantastic wrap up. Thank you. Bloomberg's chief North Asia correspondent Stephen Engel on the comments then from China's foreign minister. Sharp words, as he said, from Wang Yi. Steve, thank you. Coming up, as Friedrich Merz tries to form a government, of course, in Germany, could the political shift trigger changes in the country's energy policy? We discuss that next. This is Bloomberg. Now, Germany's politics swung to the right, of course, at last month's elections. The new government could change, then, how the country powers its economy. Joining me now is Sophia Perelli-Rocco, an analyst with Bloomberg NEF's regional energy transition team. We are awaiting, of course, the coalition, the announcement. Friedrich Merz is expected to be the chancellor, and it's very likely that his CDU will partner with the SPD. What could that mean for changes around the energy policy, so crucial for this German economy?
Yeah, of course. So under Friedrich Merz, the aim to decarbonize the economy by 2045 remains, as well as the 2038 coal phase-out target. But what changes is the overall approach to the energy transition, which becomes more pragmatic and cost-focused. If we go into the specifics, we expect support for renewables like solar and wind to continue. We also might see a push in regulations for carbon capture and storage sector. But on the other hand, the party's more technologically neutral stance could mean that targeted support for specific technologies such as heat pumps or EVs or hydrogen could see some more friction.
Germany's industry pays energy costs that are about 3 times that of the United States, about double that of China. What is the energy mix likely to be to try and address that cost?
So Germany's electricity market is in a really tight spot because its firm capacity shrunk by a quarter in the past 10 years. And that's because they shut down all nuclear in 2023 and coal is also phasing down. So while solar and wind is increasing to replace this, Germany still needs a lot of dispatchable power to ramp up when the sun isn't shining and the wind isn't blowing. And so to address this, Germany could start building some new gas plants. And this isn't anything new. The previous government also wanted to build new gas plants, but they wanted them to be hydrogen ready so that they could also contribute to a cleaner grid. Instead, Merz is also supportive of new gas plants, but he doesn't want to force them to be hydrogen ready and would actually rather let the economics drive which technologies are actually installed.
Sophia, top line. Do energy prices in Germany come down?
No, not really. And actually, German households pay 60% more for their electricity. And whilst the grid investment could help, and actually just 2 days ago, Merz announced a 500 billion euro plan for investment infrastructure, which could include the grid, this could try to tackle some of the reductions in electricity costs, but also taxes are very important to reduce the tax part.
Sophia, excellent analysis. Thank you for coming in bright and early to break that story down for us. Sophia Perelli-Rocco from Bloomberg NEF's regional energy transitions team. Coming up, Wall Street ended in the red yesterday as investors turn risk-averse over those tariffs. We get the market positioning calls from Marija Veitmane of State Street. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Another day, another tariff rollback. Donald Trump pauses levies on Canadian and Mexican goods that comply with the USMCA trade deal. Asian stocks slide on the uncertainty. We will preview today's US jobs data. Bitcoin falls after a Trump executive order for a crypto reserve disappoints investors. The White House czar on crypto saying taxpayer money will not be used to buy digital assets. Plus, Bloomberg learns the US wants to link a minerals deal with a quick ceasefire between Kyiv and Moscow. Ukraine's president says he will speak with US officials in Saudi Arabia next week. European futures pointing sharply lower after a flat close yesterday on the flip-flopping on the tariff front coming through from the Trump administration. The confusion is baked in at this point. European futures pointing lower by 1%. FTSE 100 futures in the UK pointed lower by around 45 points. S&P futures stateside after selling off 1.8% yesterday, currently pointing modestly higher by 0.1%. Nasdaq 100 futures pointed to gains of 53 points. That, though, is after a shellacking yesterday, down 2.8%. Let's flip the board and have a look cross asset. The bond sell-off, a bit of reprieve so far. Yields currently down 3 basis points, 4.24 on the benchmark US 10-year. The euro continues to strengthen, up 0.3% at 108 on the single currency. And Bitcoin is under pressure on an executive order that disappointed some of those investors, currently down 2%. Brent trading below $70 a barrel, just up 0.2% so far in the session at 69.61. So to the bond story and the market reaction. German bonds making history this week, experiencing their worst rout since 1990. The sell-off reverberating through global debt markets. Bloomberg's Valerie Teitel has had her finger on the pulse of the bond market rout this week. Bit of reprieve in the session today. Walk us through how the bond market has readjusted this week, Val.
What a monumental week it has been for European government bonds. The old adage, never go short bonds, was proven wrong this week with those yields just flying 42 basis points higher in the last session. It lifted yields across the Eurozone. And this is important, Tom, because these other countries, they are a bit more indebted. Their fiscal headroom is eroded even more with this lift to bond yields. But the other monumental move has been in the single currency, the euro on the week, up more than 4%. It has just flown at the gates. We're now talking about levels like 110, 120, not far ahead. It was only a few weeks ago, Tom, we were talking about parity. That narrative has been put to bed for now. If you look at how the euro has performed this week on a historical basis, it is the 6th best week since the inception of the euro. We've really just flown off the gates. All of those short positions unwound as we are now bullish on the European currency.
The 6th best week for the euro since its inception. Wow. What's happening in technology? What's happening in US tech? The wheels seem to be coming off, Val.
Coming off very quickly, Tom. The NASDAQ hit all-time highs just over 2 weeks ago and has slid 9% in a quick fashion. Also, the broader equity industry as well. S&P 500 testing its 200-day moving average. The Magnificent 7 testing its 200-day moving average as well. The one thing I want to point out here, Tom, is just the difference between U.S. tech and China tech. On one side, U.S. tech really taking a pummeling this year. You compare that to what's going on in Asia. HS Tech up 35% year to date. This outperformance of other world equities, of equities around the world, given that the rally in European shares and Asian tech shares as well, really taking the shine off U.S. assets at the moment.
Yeah, that divergence is pronounced, isn't it, in terms of China versus the U.S. on the tech story. DeepSeek, Alibaba, Tencent, all having a role to play. Bloomberg's Valerie Teitel, thank you very much indeed. Let's get more market analysis now. Bring in Marija Veitmane, Equity Research Head at State Street Global Markets. Maria, good morning. You have been consistently and for quite some time now bullish on US tech. Do you check that enthusiasm?
Yeah, thank you. I mean, for a long time, it was a really good call. Now market is really questioning this idea. But I think for us, what is really interesting is that market has been very long tech for, beginning of the year, and like Valerie was talking about, only a couple of weeks we made all-time high. Market really bought into the story. So positioning in tech stocks has been very, very extended. And now we hit with all the uncertainty, all the kind of news around the kind of alternative growth prospects in other parts of the market, and that really forcing investors to readjust those positions. I think it would be really interesting to see whether investors really kind of, is it position adjusting, or whether it's something more kind of watershed and we're going to new sources of returns in the market, and that's maybe a little bit early to kind of have a clear
Marija, let me try and pin you. Let me try and pin you down on this. Do you sell US tech right now, or do you use this as a window to add?
I mean, we probably be more constructive. We wouldn't be selling tech. I mean, we see lots of kind of good quality plays. And I think for us, what's really important right now is that uncertainty is huge. What do you want to have in the portfolio when the uncertainty is huge? You want to have quality bets. Where is the best earnings? Where is the lowest leverage? Where is the highest return on equity? And that's kind of all roads lead to tech. So I think we need to wait for the kind of the end of this route. We need to wait for volatility to come down. And what we saw a lot last year is that after the rout, investors came back to tech. So we expect something similar.
China Tech trading at 18 times forward earnings. That is about a 40% discount versus their US counterparts. Are you adding China Tech at this point?
I mean, we don't have a specific like holdings in China Tech, but what we see in terms of overall exposure to China, to Hong Kong, investors have massive underweight positions. And again, that kind of chimes with the story kind of we're thinking about in the market, that position adjustment. So investors are squaring up those positions. And in China, there's still big underweight. There's still more to add. So that trend continues for some time. But again, as I said, I mean, we're very skeptical that that's like a reversal of this big trend, so it's more tactical play for us.
Marija, has Trump killed US exceptionalism?
Very good question. I mean, well, what is really interesting, and we're watching it every day, so we have this idea of kind of measuring market narratives, and one of them is trade war and international kind of corporations and things like that, tariffs. And what we're watching is that that's very like one of the most talked topics in the market right now, understandably. But if we measure the kind of correlation with market moves, it actually has diminished very significantly. So I think with tariffs on, tariffs off, like policy by tweet, I think market is kind of getting a bit tired. Market to some degree positioned for that, and then we're moving on. And what we're moving on is profitability. Is I think interestingly, U.S. consumer spending coming up along a lot, and I think the idea is that if U.S. consumer continues to spend despite all this uncertainty, U.S. economy will be strong, and corporate earnings will continue, and then we go back to kind of the old narrative, where is the strongest earnings, and that's U.S.
Marija, we'll switch focus then to Europe. The ECB cutting rates as expected yesterday. Let's take a listen to what Christine Lagarde had to say, and then I'll get your reaction on the back.
Our monetary policy is becoming meaningfully less restrictive, as our interest rate cuts are making new borrowing less expensive for firms and households, and loan growth is picking up. At the same time, a headwind to the easing of financing conditions comes from past interest rate hikes still transmitting to the stock of credit, and lending remains subdued overall.
Marija, what assumptions are you making about how supportive the ECB will be for this Eurozone economy for the rest of the year?
I mean, the thing that I was kind of thinking about when listening to Christine Lagarde yesterday and again today is less restrictive. So it's still restrictive, it's just less restrictive. So ECB can potentially help, but I mean, clearly this big rally we're seeing in European assets, it's not about ECB, it's about fiscal, and that's really important. That's really the kind of the factors that changed what's happening in Europe. So that's, to us, is really important.
Marija, do you lead into that? Do you lead into that trade? Do you lean into that trade?
Partly. So what we see again in investor holdings is that investors were very quick to close underweight in European stocks. So that position has been closed, and we are watching whether they're adding. Where investors have not closed positions is euro is still underweight, so that's to us a better opportunity. And the other interesting kind of observation from investor holdings is bonds where at the end of the month, so we have a couple of days since, but it was the biggest position institutional investor had in developed market sovereign bonds. So to Valeria's point, don't go short don't go short bonds. That's exactly what investors had. So investors were caught kind of wrong-headed in Europe more so, and in bonds. So that's potentially where the trade is, not European stocks.
Okay, bonds and the euro. Marija Veitmane, equity research head at State Street Global Markets, continuing to say, though, that all roads still lead to US tech in terms of some of the fundamentals. Marija, thank you for the market analysis. Now, some other stories making the news this Friday. Chancellor of the Exchequer, Rachel Reeves, says she will reform the UK's welfare system as part of a government drive to find savings to help plug a hole in the public finances. Speaking on a Sky News podcast, she said the system is, quote, letting down taxpayers because it's costing too much. Reeves is weighing cuts as she tries to make the sums add up ahead of her spring statement on March the 26th. President Trump says he will probably extend the deadline for the sale of TikTok if a deal is not reached by April 5th. Trump had offered the app's Chinese parent company ByteDance a 75-day reprieve from the bipartisan law that had set a deadline in January to sell its US business. However, it's not clear if the president could legally offer a significant additional extension without a deal. Broadcom soared more than 13% in late trading following upbeat sales forecast on AI demand. The Apple chip supplier said sales will be about $14.9 billion in the three-month period to May, beating analysts' estimates. Chief Executive Hock Tan cited AI spending as a key driver in the first quarter. SpaceX has lost its second Starship rocket in less than 2 months. The projectile spun out of control before appearing to break apart during its 8th test flight. The rocket split apart as planned, but the spacecraft began tumbling and lost contact with mission control around 8 minutes into flight. CEO Elon Musk posted on X calling the mishap a minor setback, saying the next ship will be ready in 4 to 6 weeks. Coming up, Europe's defence in the spotlight as the continent deals with the US prospects of less support, or the prospects of less US support. We're going to bring you the details in today's Big Take. That is next. This is Bloomberg.
C'est-à-dire que compte tenu de la menace et quoi qu'il advienne, given the threat and whatever happens in Ukraine, we need to increase our defense capabilities and we need to build, in the next few years, autonomous defense capabilities for Europeans.
French President, of course, Emmanuel Macron, speaking yesterday as EU leaders met to discuss boosting defence spending. Let's bring in at this point Bloomberg's Andrea Palaciano, who is and has co-written a Bloomberg Big Take on Europe's defence capabilities and how the continent would fare against Russian aggression without US support. It is your must-read of the day. Andrea, what is your current assessment then? You've been crunching the numbers, you've been looking at the details. What is your current assessment of Europe's abilities to defend itself if the US were to pull back today?
Well, the issue is that Europe simply hasn't been even envisaging the possibility of having to go to war without the US in the past decades. And so what we see today is that it fully relies on the US for a number of things that it simply does not have the capacity to do today on its own. And those are the strategic enablers, as they are called, which are strategic communications, intelligence, space communications, but also air and missile defense. And so there are simply a number of things for which Europe would need several years, sources tell us at least 5 years, to be able to hold their own without the US.
Okay, so that's a bit of the time frame, Andrea, then, at least 5 years. Can you kind of flesh that time frame out for us? How does that apply across different military capabilities in Europe? Is that the timeline we should be thinking about? 5 years before Europe can really defend itself against Russian aggression?
So defending a continent is so complex that there are many layers of things that Europe would need. So if you think in terms of like what happens if Europe is attacked, and today what defense officials are telling us is that for a number of things like as simple as ammunition, Europe would probably falter within days or weeks. So there are very simple things that Europe needs right now, which are stocks, infinite amounts of ammunition. That's what our sources tell us. So ammunition, that is something that can be ramped up fairly quickly. Then there are more complicated things like logistics. How do you get tanks to the front line? How do you airlift them? How do you develop sufficient intelligence capacity, space intelligence? Those are things that need a lot more time. And one of the biggest issues Europe has right now are air defense capabilities. And the problem with air defense is that it is extremely costly and also very sophisticated. So for those things, definitely we're thinking in terms of years and hundreds of billions of dollars or euros.
Andrea, what is the current level of dependency that Europe has on the US when it comes to some of these military capabilities? And is Europe thinking about continuing to purchase hardware from the US in the long term, or are they trying to build out supply chains to have full capabilities in Europe, ex-US?
Well, if you think in terms of the full defense of the continent, there's one thing that Europe is almost fully dependent on the US for, and that's the nuclear umbrella. Right now, the whole continent of Europe is protected by the US nuclear umbrella. And so we've seen first overtures by President Emmanuel Macron, for example, who is thinking of offering the French nuclear umbrella to more countries in Europe. But obviously, even if the UK and France do have nuclear capabilities, it's no match for the US nuclear arsenal. So that's the first thing. And then obviously it's a whole debate right now in Europe whether to buy European or to continue buying from third countries. And the truth is, even if Europe is going to probably try to focus on its own industry in the next few years, there are certain things that it's just too dependent on the US for right now. And air defense is one of these things.
Okay, Bloomberg's Andrea Palaciano in Brussels. The big take is really worth your attention this Friday morning to get a deeper understanding of where the gaps lie and how Europe can fill and make up for that dependency on the US. Now, in just over half an hour's time at 7:30 a.m. UK time, we're going to be speaking exclusively with the European Commissioner for Defence and Space. So we continue that conversation and get some insights from Andreas Kubilius. Oliver Crook bringing us that interview later in the show. 7:30 a.m. UK time on the opening trade. So tune in for that conversation as well. Some breaking lines coming through from the Prime Minister of Hungary, Viktor Orban, saying that Hungary will work to slow Ukraine's EU accession process. This is Viktor Orban speaking on state radio. He's been talking about Ukraine. And again, the top line from this interview so far, saying that Hungary will work to slow Ukraine's EU accession process. We know that is something that Volodymyr Zelensky of Ukraine has pushed for, of course. Let's listen in to what Viktor Orban had to say at the meeting of EU leaders in Brussels yesterday as they debated how to adjust Europe's rules to ramp up spending on defence. Let's take a listen.
So the European Union has isolated itself from the United States now, isolated himself from China because of the trade war, and isolated himself from Russia because of the sanction policy. So if somebody is isolated here, is the European Union as such. Hungary has a good relation to all three directions, so we are not isolated at all.
Okay, Viktor Orban, of course, Prime Minister of Hungary, saying it's not Hungary that is isolated, but it's Europe itself that is isolated from Trump, from the US and from China. Of course, Hungary could be a key block against additional spending on defence, though we know that European leaders are looking at workarounds to that potential conundrum. There's plenty more coming up. Stay with us. This is Bloomberg.
Well, the market now, I think, put 3 cuts in after some of the data. And the market's been all over the place in a sense because over the last 90 or 120 days, I bet you we've had 5, 6 cuts to 0 cuts, back to 3 cuts. Our team believes that the Fed is kind of done cutting rates until inflation kind of gets in control. They believe that and I'd say they may, as they're thinking about that, given that if these tariffs go in, they thought that it would have some impact on the growth in the U.S., and that may cause them to think about that. But right now they're saying, look, you've got a real rate structure, which is Fed. You've got employment pretty stable and loosened a lot over the last year. And so maybe their view is there'll be no cuts. We'll see what happens if they start to see.
You also don't think inflation is getting under control or there are upside risks?
Our team of economists always thought it would take 3 years to get inflation under control. And so they projected to get down near the target towards the end of 26, but it takes that long. And everybody says, why isn't it happening faster? It just takes a while for it all to work through the system, especially with the amount of stimulus and other things that went on.
Bank of America CEO Brian Moynihan, of course, speaking to us exclusively. Jobs data, non-farm payrolls dropping later today. There is great interest in the markets, of course, always around this data print, but the expectations are building because the risks are that you're starting to see a softening labour market. We had a survey out yesterday, the Challenger survey, showing a big pickup in terms of the number of job cuts announced at the federal level, of course. We've seen Doge doing their work, but also in tech and retail. So the non-farm payrolls print today with a focus, of course, on the earnings story as well when it comes to your questions about inflation, because there is a risk, for some at least, that you have a scenario where the US edges into stagflationary territory. We are not there yet, but that is a risk that some in the markets are weighing up. In terms of the jobs data top line, you're expecting a print of 160,000. That is the expectation for the month of February. That's above the previous month of 143,000. The unemployment rate expected to stay at 4%. Again, for me, the interest is going to be, when it comes to how you think about inflation, the average hourly earnings month on month expected to drop to 0.3% from 0.5%. That is the preview then of the jobs data as we lead up to that later today. We'll have full coverage. Let's flip the board and have a look at how is happening when it comes to the euro. What a week for the single currency. In fact, putting its best weekly performance in. The 6th best weekly performance since the euro's inception. Gains of 4% on expectation, of course, of additional defence spending, hundreds of billions of euros in defence spending, primarily from Germany. What that means for the ECB, they cut yesterday, yes, but we now also know from officials that they are finally split on what to do in April. The market's been fading expectations around additional ECB cuts. So the spending impulse and fewer cuts from the ECB has strengthened the euro. Hedge funds are piling into positions around 110, some even called for 120 around the single currency. Let's briefly flip on and have a look at the divergence when it comes to the China tech story as well, because we are having to rewrite so many narratives right now. And one of them is US tech performance. That has flipped on its head. Chinese tech performance in the white line, that is HS Tech, massively outperforming US tech year to date. You are in correction territory with the MAG 7. You are closing in on correction territory with the NASDAQ 100. China tech, though, is soaring. 4 p.m. London time, Bloomberg Technology will speak with the White House AI and crypto czar, David Sachs, on the US government's new Bitcoin reserves. Some disappointment there. Bitcoin under pressure today. Coming up, though, it's the pulse of Vincent Lacroix, but before that, it's the opening trade. Stay with us. This is Bloomberg.